How safe is your money in a US bank account? We saw in an earlier video that even though you're an Indian citizen holding an Indian passport, living within India without a US visa, it is possible for you to open a US bank account. In India, if you hold an Indian account in a bank and the bank fails for some reason, then we know that the Reserve Bank of India has a scheme by which they insure up to 5 lakh of rupees. However, the US bank is not under the jurisdiction of Reserve Bank of India. So what would happen in case that bank in the US were to fail?
People assume that as a non-US visa holder or a non-residential alien, opening a US bank account is just about convenience. But here's something most miss. Unlike many countries, the US banking system offers a unique safety net, the FDIC guarantee. And yes, it protects even NRAs up to certain limits if a US bank collapses. The FDIC stands for the Federal Deposit Insurance Corporation, was created in 1933 to build trust in banks. Today, it guarantees up to $250,000 per depositor, per bank, per ownership category. So, as an NRA, this means if your US bank goes bankrupt, FDIC directly pays you back within those insured limits. It doesn't matter if you live in India or anywhere else in the world. The guarantee applies as long as your deposits are in an FDIC-insured bank. This is very different from many emerging markets where deposit insurance is capped very low, or the payout process can take years. When you hear the FDIC will pay back deposits within days up to $250,000, the natural question is, where does that money come from? Is it the US taxpayer money? Does the government bail out deposits? The answer may actually surprise you. Every FDIC-insured bank pays a quarterly insurance premium into a deposit insurance fund. The premium is based on a bank's assessable deposit and risk profile. As of recent FDIC schedules, rates range from 2.5 basis points to 42 basis points annually, based on the bank's total assets and depending on how risky the bank is. So, safer, well-capitalized banks pay the lowest rates, and riskier banks with not so high credit quality or weaker capital get to pay higher rates. So, let us give an illustration. A bank with $10 million in deposits and a safe risk profile might pay around $25 million per year in FDIC premiums. This is the 0.25 basis point scenario. However, a riskier bank with the same $10 billion in deposits could land up paying up to $42 million. So a mental model for this can be like that of a car insurance. A careful driver with a clean record pays a low premium, but a driver with multiple accidents pays a higher premium. Similarly, JP Morgan or Wells Fargo pay millions each quarter, while smaller community banks pay much less, but everyone contributes to the same fund. This protects deposits up to $250,000 per account. So, when FDIC pays depositors after a bank failure, it's not free money. It's the insurance pool funded by banks themselves. So, the stronger the system, the lower the overall risk. The taxpayers are not paying these premiums, the banks are. The FDIC is a self-sustained, self-funded model. This has a direct benefit globally. In case there is mismanagement in a bank, it is not that fresh dollar is going to be issued by the Federal Reserve, and hence, to that extent, the dilution of dollar is not there. So, if the US bank fails, how long do you need to wait for the compensation to kick in? That would be the next question that would come to our mind. The FDIC steps in very fast. In most cases, insured deposits up to $250,000 per depositor per bank are made available within 1 or 2 business days. This means whether you are a US citizen or a non-residential alien, your money is protected and quickly accessible. Here are some recent examples. Silicon Valley Bank 2023. FDIC created a bridge bank over a weekend, and by Monday after the closure, depositors with insured balances could access their money. Let us take a Washington Mutual case of 2008. JP Morgan Chase acquired the bank the same day. FDIC seized it, so depositors had next day access to their insured deposits.
So here's the big takeaway. When you as a non-resident alien invest and open a bank account in the US, you are opening a bank account which is well managed, globally diversified, risk managed, and well funded. And on top of all of that, you have a FDIC's guarantee of up to $250,000. Hence, in your context as an investor in the stock markets of the US, your position of having a US bank account is in principle like that of a pipe that has the least friction. By investing your money in a US bank account, you are actually reducing the friction and also keeping it well insured and well oiled. So the next important question that we need to ask ourselves is, what makes investing in the US markets attractive? Is the US index as promising as it looks like? And as an Indian, why do we need to look at the US market index for investing in the first place? We will cover this in the next section.